Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Hi, this is Jason Adams, Portfolio Manager at Fairport and Luma Wealth, returning for another edition of the Fairport Flash. It's hard to believe we are already halfway through the fourth quarter of 2021 and about to turn the calendar to 2022. I would be remiss during this time of giving thanks not to express the gratitude I feel to work at an amazing firm energized by our mission of inspiring families. Additionally, I think I can speak for all of us when I say how thankful we are as a firm for the relationships we have with you, our clients. I genuinely look forward to meeting more of you and seeing again those of you I've already had the pleasure to meet. Lastly, I want to say thank you to my colleagues and teammates. It's been a great first year, and I could not be more excited about what the future holds. So with the calendar ready to turn, I thought it'd be timely to talk about the three most important issues we expect to impact financial markets in 2022. To avoid personal bias, I surveyed the investment team for their lists of most important issues. Not surprisingly, the team answers provided a pretty clear consensus as to what those three topics will be. So without further ado, in order, here are Fairport and Luma Wealth's three most important economic and market issues for 2022. Number one, inflation. And that includes supply chains, labor shortages, commodity prices, all those things I'm grouping together in inflation. Number two, monetary policy. And number three, COVID. Inflation and monetary policy are very much intertwined, with one impacting the other and vice versa, so I'll come back to those two. I'm going to start with COVID. And clearly, if we would have done this exercise last year at this time, COVID would have made the list. By June of this year, it looked like we may be out of the woods, but the rise of the Delta variant served as a good reminder of how dangerous an enemy the virus still is. The fact there could be additional variants and breakouts here and around the world and ultimately impact the economic activity of the world is why it indeed made the top three. There are still 47 million people fighting COVID in the United States alone. There's no question a ton of progress has been made in 2021 in regards to learning how to live with the virus. In total, just under 228 million vaccinations have been administered, with more than 68% of the population receiving at least one dose. Daily cases are well off their Delta peaks reached in late August, early September, but again have started to pick up recently here in November as Northerners move inside. Here's a look at the trends in confirmed cases and fatalities, along with progress towards herd immunity. Clearly, both provide reasons for optimism. Also, a look at high-frequency economic data shows total debit and credit card transactions 24% above pre-pandemic levels, and gradual improvements in hotel occupancy, seated diners, and TSA travelers. Perhaps most encouraging is the fact Pfizer recently developed a pill that shows an 89% reduction in risk of COVID hospitalizations or death in non-hospitalized adult patients that already have the virus. On the heels of this announcement, which was back on November 5th, I believe, Pfizer board member and COVID expert Dr. Scott Gottlieb said that the pandemic could officially be over by January. If correct, it would certainly be a wonderful way to start the year, but until victory is declared, we're going to put COVID as one of the three most important issues to watch, and that could impact markets and risk appetites come the new year. Now let's switch gears and talk about inflation. It is here, ladies and gentlemen. In October, the Consumer Price Index reached 6%, and you can see the sharp increase in consumer prices over the last 12 months or so in this slide. At 6%, it's the highest it's been since the late 70s, early 80s. It can be seen not only in the CPI, the Consumer Price Index, but in the Producer Price Index, the GDP deflator, price components of the ISM surveys, as well as commodity prices. The percentage of small business that plan to raise prices is at an all-time high, as evidenced in this chart. Commodity prices have surged off the 2020 bottom. Investors are buying inflation protection in droves, as you can see in this chart. To me, it appears the debate of transitory versus permanent is largely decided. Wage growth is permanent, and you can see on this slide it's already above average and moving higher. Rent increases are permanent. and are starting to rise substantially. So to me, we are in an inflationary environment, which isn't necessarily a bad thing. Oftentimes, it's accompanied by higher wages, which can lead to more consumption and more consumer spending. Corporate earnings are indeed nominal. In other words, earnings move higher with higher prices, all else equal, as do revenues. When I say it's permanent, I do not believe we'll be running at a 6% consumer price index next year at this time. By its nature, I expect CPI to cool over the course of 2022. CPI is a measure on a year-over-year basis, so inflation will likely cool due partly to the arithmetic of it, in that you're starting at a higher base. Think about Tyson's Foods, for example. They have increased the meat prices by 33%. I think it's safe to say they're not going to be increasing meat prices by another 33% in 2023. So just consideration of that fact alone, you would see inflation cool as we move through 2022. Furthermore, we expect the labor participation to improve and supply chain issues to ease. Most investors expect those pressures to abate in the first half of 2022. There are early signs as vehicle production, semiconductor lead times that the worst of those constraints may already be behind us. Jamie Dimon, CEO of JP Morgan, has said he believes we will already be past peak supply constraints when the calendar turns to next year. Lastly, on inflation, I know one of the most important things I will be monitoring is long-term inflation expectations. This chart shows the 10-year break-even inflation rate. As you can see, it has moved higher, but still remains well below 3%, which tells you the market believes the Fed maintains the monetary tools to control further price increases. If this rate breaks significantly higher, then inflation will become a more significant problem for the economy, for the markets, and for the Fed. Speaking of the Fed, that dovetails nicely right into monetary policy, the last of our three topics for 2022. The FOMC, the Federal Open Market Committee, chaired by Jerome Powell, has a dual mandate of full employment and price stability, essentially the orchestrator of U.S. monetary policy. From a market perspective, it's as much about managing expectations as it is managing policy. The market does not like surprises, so the Fed has to walk a delicate balancing act between managing expectations and reacting to real-time data. In my opinion, a policy error, specifically getting too far behind an economy expected to grow at 8% in the fourth quarter, with inflation running at 6%, is the number one short-term risk in the markets. The good news is that if indeed the Fed does find itself behind, it means the economy is performing very well. So any sell-off in financial markets related to a surprise policy move would likely be short-term in nature. So here's a look at the Fed's current monetary policy, starting with the Fed's funds rate. Currently set at 0, you can see the market expectations are above FOMC estimates. So the market is already onto the fact that the Fed could be a little behind. The next chart is a look at the Fed's balance sheet, which is expected to continue to grow through June of next year at a declining rate as the Fed tapers its current $120 billion per month purchase of Treasury and mortgage securities. In fact, the FOMC announced a plan to reduce those monthly purchases, or taper, by about $15 billion per month through the middle of 2022. Going forward, expectations for a Fed funds increase appear to be moving into the back half of 2022, and we would not be surprised to see the Fed reduce its asset purchases more aggressively than their current plan suggests. One last uncertainty we're dealing from a monetary policy perspective is exactly who the chairman's going to be come February of next year. Jerome Powell is largely expected to be chairman again and be put in that role by President Biden, but it looks like the odds of him getting that role are declining in favor of Brainerd. So it's about 60-40 Powell to Brainerd right now. Interestingly, Brainerd is even more of a dove than Powell. So you're seeing as Brainerd chances improve at winning the chairman, you're seeing more value cyclicals do well. And then when Powell sees his odds of winning the chairmanship improving, you're getting more of a rally out of growth and that side of the market. So there you have it. Those are our three big issues for 2022. We have inflation monetary policy, and COVID. Let us know what you think. We want to know what's on your mind. What are your top topics? What are the things that you're thinking about as we roll into 2022? We want to know, so please reach out, contact your advisors. Let us know if there's any more information you'd like on any of the topics mentioned in this podcast. We certainly wish you health and happiness through Thanksgiving and the holiday season, as well as the new year. And again, I look forward to meeting those of you I haven't met and seeing again the people I've had the pleasure to meet. So wishing you and your families all the best through the holidays. Thank you.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.